I have some bad news for everyone today. The consumer stocks, the consumer staples, they're finished. They're just not going to be able to compete in business anymore. The companies like Amazon.com, they're coming in, they're taking over. Consumers no longer want to buy the brand names. They want just to buy the cheaper version, the generic version of products. And these consumer staples, they're just gone. And in addition, just the results, they're abysmal. When one looks at the numbers, they're just horrible. They're not good, and so they're gone. I'm just kidding. If you've been watching my channel for a long time, you know this is not the case. You know that I love these companies. Today's video is in response, though, to that sentiment. That's what the media would want everyone to believe right now. That is what everyone is talking about, and I could not disagree more. I think there is a lot of hype here against the consumer stocks, and I think there is, I think it's wrong. So I've got some insights to share today, and I want to particularly share some insights about Clorox Company, which just got downgraded, a stock that I own, and Procter & Gamble, which just had a quote-unquote lackluster quarter of earnings. So let's jump right into it. All right, everyone, so I want to start out just with two practical examples. I want to speak about the Clorox Company, and then I want to speak about Procter & Gamble. These are both companies that I own. These are both consumer non-cyclicals, dividend-paying companies, companies that I love. They've been increasing the dividends on a yearly basis. They pay a lot of cash flow, and they're two of my core positions. These are positions that are major positions, positions I love, and I'll link below. I've been averaging in and buying more Procter & Gamble this year. I love Procter & Gamble, and I love buying it in 2018 when everyone else hates it. So let's start with Clorox. Yesterday, Clorox Company, it was down 5.97% in a single day. Why was it down? An analyst at Morgan Stanley said, hey guys, consumers are favoring smaller brands versus more established ones. You know what? Analyst speaking here, I'm going to cut this stock from an equal weighting to an underweighting. The expectations, the consensus, they're too high on organic sales growth and gross margins. I'm going to lower my 2019 earnings per share target. And you know how much I'm going to lower it by? I'm going to lower it by 1.9%. Regarding analysts, check out the link below. I'm going to share some insights about what I think about analysts. My main takeaway that I love with analysts is they create buying opportunities for investors like me. But anyways, let's just look at this objectively. An analyst says, I don't want this to be an equal weight, I want it to be an underweight. And they say in 2019, I'm going to adjust my earnings per share down by 1.9%. The stock tanks by 5.97% in a single day because of that. That's crazy. Come on, that's ridiculous. And so let's look at the real facts. I'm going to link in the description below. Clorox just raised their dividend 14%. Management team, board of directors would not authorize that unless they were doing really well. And 14% dividend increase, in my opinion, doesn't get much better than that. What else? I looked at their 2017 annual report. Sales growth, 4% growth year over year in terms of sales. Great for a big established company like Clorox. What else? 9% diluted earnings per share growth. Year over year, 2017, they grew by 9% earnings per share. 2016, they grew 8%. So last 2 years, 8% growth and 9% growth on earnings per share. What else? 871 million net cash continuing from operations. 13% year over year grow in that cash flow. Okay. The analyst all of a sudden says, hey, consumers may not want Clorox's brands. I'm going to lower my earnings per share by estimate by 1.9%, and the thing tanks. But you look at the real numbers, and the dividend's up 14%, revenue is up 4%, EPS is up 9% year over year. Something doesn't add up. And so the takeaway here is everyone needs to look at the numbers themselves. When an analyst comes out with a bold statement like this, it's oftentimes advantageous to question the analyst, to think, hey, is this analyst have other motives? Is this analyst just looking at it wrong? Is the analyst too short-sighted? As a long-term dividend investor who's holding for decades on end, I don't care if the earnings per share is 1.9% lower next year. I don't care if it's 10% lower, quite frankly, because I'm looking at the long run. And I'm looking at the numbers. When I look at the numbers, they look quite good. So what's really happening here? Why did the stock react like this? I think there's a few things happening here. The market has been expensive, and it's been expensive for a while. I've been watching a lot of stocks, and a lot of them are just starting to tank. And they're tanking on actually good news or slightly negative news or neutral news. And they're doing this, quite frankly, because I think the market is ready for a correction, and it's starting to correct. And so I kind of look at stocks going down on no real news like this one as an indication, hey, Ian, there's probably going to be some buying opportunities ahead. Hey, Ian, this market is probably towards its peak and it's going to start coming down. I mean, it already has, but it'll probably continue. Hey, Ian, just tread with caution. But quite frankly, it's not the end of the world, in my opinion. It's not the end of the world. And so I actually try to look at this within a mind of happiness, with a mind of seizing the opportunity. Because when stocks correct on neutral news or slightly negative news or sometimes positive news, like Clorox, quite frankly, in my opinion, I don't care what that analyst says. Basically, I love it. I love those kind of buying opportunities. That said, eyes wide open, I think it's important to realize also that, look, it fell 5.97%. Maybe it'll fall quite a bit more because it's still gone way up over the last 10 years. And it's probably going to be time at some point for a correction. And so I love the sale. I love the fact that things are getting cheaper. I hope that they get even more cheaper and that there's better buying opportunities, because the cheaper the stocks, the higher my yield on cost, the higher my starting yield on cost, my dividend yield, more cash flow coming in day one when the share price goes down. So as long as the fundamentals of the company are good, like I believe they are for Clorox, I love these opportunities. Now, the only thing I do want to say is I don't want to completely discount what this analyst is saying, and I'll talk about this later. I've got kind of lessons, top lessons from this video, and one of the lessons is eyes wide open. There probably will be some disruption. There probably will be some challenges out there in the marketplace, but the way I look at it is companies like Clorox, they're going to figure it out. They have been. They've been around for a very long time, and they will probably do that organically, but they'll probably do that through acquisition as well. For example, Clorox, they acquired the Burt's Bees brand a while back, and that's an example of an acquisition that really paid off. I love Burt's Bees. It's one of my favorite reasons that I own Clorox. And so anyways, let's move forward. Procter & Gamble. This is a tale of two stocks today. Full disclosure, I own Clorox, I own Procter & Gamble. Both are in my portfolio. Procter & Gamble, it was down 3.27% yesterday. And that's actually a big deal because it's already at like basically a 2-year low. I'll link in the description below. It's one of the two stocks, or one of the many stocks, but one of the two core stocks I'm really focused on this year. I'm accumulating it. And there's a few things that happen. They released earnings, but they also announced that they're going to be buying from Merck, their consumer health business. When a company acquires another company, it typically goes down. This actually is the case with General Mills as well. I'll link in the description below. I love General Mills. I started buying it this year. They acquired the pet food company, and the General Mills went down. Usually when a company makes an acquisition, the company making the acquisition goes down. So I think part of the reaction is because of the acquisition, but Procter & Gamble getting into buying Merck's business, their consumer health, I love it. I love that kind of acquisition. That's a great acquisition, so I'm real excited about that. Anyways, what happened? Well, when I look at the reports out there, the press, it says Procter & Gamble's profits are flat. But when I actually look at the real numbers, earnings per share are up 4% year over year. Sales are up 4% year over year. Now, organic sales, if you take out the foreign exchange rates, you take away like deconsolidation, mergers and acquisitions, divestitures, organic sales are up 1% year over year. So they're not up 4%, they're up 1%. But the fact of the matter is, people are going out there, they're saying, hey, Procter & Gamble, your business is over. People don't want to buy your stuff anymore. Look, the revenues are up 1% year over year. This is a very big company. Growth will probably be slower for some time, but they're turning the corner. The revenues are starting to grow. They're smart. They've got the resources. They can make acquisitions, they can innovate, they can compete head-to-head with anyone out there, and they've got the distribution. So quite frankly, I think there's a lot of overreaction, and I think there's a story. I think the media, sometimes they run with this story. They want to believe that companies like Amazon are going to take over. And I wish Amazon the best. I use Amazon. We love Amazon. It's great. But it's not one or the other. There's room for everyone. There's room for everyone to succeed. And so I just don't understand this narrative that comes along that all of these companies are doomed because Amazon's doing well. Well, why can't it be that Amazon's doing well and everyone else is doing well? And why can't it be that, well, wow, because Amazon is doing well, Procter & Gamble all of a sudden has a new avenue to sell their products? And why can't it be that, oh, Procter & Gamble, they're going to partner with Amazon or strengthen their partnership and everyone's going to win? It seems in the media it's always one or the other. Someone has to lose. And I think they paint this picture because it sells stories. Fear sells stories. It sells. And fear captivates people's attention. And I don't like this fear. Well, I actually do like the fear because it causes the stocks to go down. It creates values. And so with companies like Clorox, Procter & Gamble, am I scared that the future of consumer non-cyclical is doomed? No, they have no future. That's the furthest thing from the truth. These are the basic goods that we all need to live on. And these companies, in my opinion, humble opinion, they'll be around, they'll innovate. Will they face some challenges? Surely. Are things being disrupted? Surely. Will they get through it? Yes. It's all about that long-term perspective. And so I just have to see stuff like this and I have to laugh. But that being said, I'm not trying to laugh at you. I'm responding to a question here. This is a question on my channel that just came in. And the reason I'm answering it is if one has never been through this before, if one has never experienced this before, it can be scary. I've been investing for over 20 years. I own 37 dividend paying stocks. I have been in the game. I've been through the ups and downs and I've made a lot of mistakes along the way. And I've learned the hard way. And so the takeaway here is you might have not been through that before. This might be new to you. This might be scary. And so the core purpose of this video is not to poke fun or to say you shouldn't be scared, but it's just to show my perspective that I'm not scared because I've been there, done that. I've seen that. History repeats itself. It's the different narrative, but there's always going to be a narrative. And it's typically a good opportunity to start thinking about averaging in my humble opinion. So I want to talk about some takeaways. Takeaway one. This punishing of these consumer non-cyclicals, it's overdone in my opinion, based on the raw data, like the data I shared today. That said, I think it will continue, and I think it's going to get more overdone. So a word of caution that, for myself at least, I average in. I don't want to deploy all my capital now. I want to average in because I think I'll see progressively lower prices, and the lower the share prices go, the higher my dividend yield goes, and I'll have more money that I can literally use to pay the bills. Number two, buying opportunity, I love it. It's a hard lesson to learn, but it's a lesson that I learned, and I have to look at stuff like this and love it. One way that I embrace it even more is I don't really look at the overall value of my portfolio on a day-to-day basis. I look at how much dividend income is coming in. As long as that stream is rising, I like it. And I can make the stream rise quicker if I have a buying opportunity. Lesson three, I think there's more to come. I definitely think the next 3 to 5 years, there's going to be a lot more to come. I'm not trying to scare folks out there, but I am prepared for the share price of Procter & Gamble to get cut in half. Maybe that will happen, maybe it will not. I will be buying all the way down and all the way back up. That's how I am, but I'm prepared for more to come, and I am not going to let it change my level of confidence. I'm not going to let it change my strategy, put me on a different path. I just have to be ready for it. And so correction. I think we're starting to see a correction. I think it's gonna be more of a correction, but who knows? I think there could be a period of prolonged slower dividend growth. Look, Clorox just raised their dividend 14%. That's kind of an outlier though. Some of the other guys like P&G, it's been a little bit slower as of late. That being said, I'm just preparing myself. I'm in this for decades. If there's a few years of slower dividend growth, I'm prepared for it. I certainly don't see a case where the dividend gets cut. I certainly don't see a case where the dividend even gets stalled. That being said, this is something I'm prepared for. And I don't mind it because, again, slower dividend growth spooks people, share prices go down, better buying opportunities for folks like me with a long-term vision. Sky is not falling. As much as the media would want folks out there to think that the sky is falling because it sells more stories, the sky is not falling. The sky is not falling. Diversify. I would have never thought this. Look at my portfolio yesterday, a lot of red, things going down. What was green? My energy stocks. I had picked up energy stocks and I kind of went aggressive when oil was just basically really low, real low. And I bought the energy stocks when people were saying that these energy companies, they were going to cut the dividends, they were going to, and some of them did, but not the ones I own. And I'll do a video on this, by the way, a separate video. I bought those when the sky was quote unquote falling. But isn't it a fun turn of events just a few years later that these darling stocks, these consumer non-cyclicals, the sky's falling for them now, and my energy stocks are actually doing well. But this is the case where diversification is important. And I stress consumer non-cyclical a lot. But the fact of the matter is I own 37 stocks and I have representation over most major industries. And I love the diversification, and if anything, this is a reminder to me that, hey, Ian, yeah, go in on these stocks, buy more Procter & Gamble, but that being said, don't lose sight of diversification. Keep your portfolio well diversified, not only by number of stocks, not only by representation, but look at the raw dollars you have allocated to each industry, and don't get too skewed. Don't get too skewed in consumer non-cyclical. Yeah, I kind of faced that already. That's a challenge I faced, and it's a good reminder to me. Disruption-proof portfolio. I love this one. I have someone here on my channel that's been commenting. I always look forward to his questions, his comments. This is someone that said, hey, I'm just building a portfolio of utility stocks because these are disruption-proof. I love that. I think all of this happens for a reason. Like I said, I have full confidence in the future, and I like these buying opportunities. That said, you got to look at both sides of the coin. Maybe the media, maybe these analysts are saying something of value, and there's some truth to what they're saying. Probably a good time for all of us to find our comfort level. And how can we create a portfolio that is disruption proof? Can we do it by adding utility stocks? Can we do it by just diversifying across industries? How? Everyone needs to come up with their own answer, but this is something that is on my list. Love this one. Financial independence. It is not without risk. So even though I invest in these blue chip companies, these stable companies, these great companies, there's risk. There's risk with investing. That being said, what are my alternatives? I want to drive cash flow. I want to have more freedom in my life. I want to pay the bills with passive income. One day I want to live off of all my passive income. Show me alternatives that are better than dividend growth investing. Surely I participate in some of the others. I work in the commercial real estate space, specifically on properties that produce cash flow. I do a little bit of online marketing, affiliate marketing, so there's other ways to earn income. But at the end of the day, what I've concluded is dividend stocks are one of my favorites by far. And yeah, it comes with some risk, but that said, okay, let's just say it's too risky, I don't want to do it. What are my alternatives? In the sense that how can I get where I want to go otherwise? I just don't see a path. And so for me, I embrace the risk. I know there's the risk, but I understand the risk, and it's eyes wide open. And certainly as stocks get cheaper, the risk is less. And so that's part of the point too, is the more overdone the sell-off gets, as I average in, the less risk there will be. And so interesting point here. Number 10, look at the numbers yourself. We already talked about this at length, so I don't want to spend more time, but it goes without saying that when I look at the numbers for Clorox and Procter & Gamble, I think the numbers are fine. They're just fine, especially with Clorox. That one, I mean, come on. I don't know what that analyst is thinking, but maybe he's right, maybe he's not. We'll see. So I want to leave actually with a closing point today. I jotted down something about Amazon. Right now, Amazon.com price earnings ratio is 253. They're trading at 253 times earnings. And there's no dividend, and the profit margin is 1.7%. The operating margin is 2.31%. No dividend, those kind of numbers, no thank you. Amazon, I love you. I use your service, and we enjoy it, and it adds value to our life, but it's just not an investment for me. I mean, and I don't want to put down people who are investing in Amazon. I have friends who are investing in Amazon. I wish them well. Some of them have done incredibly well. They got in early. They've seen hundreds and hundreds of % gains, and I wish them well. But I'm just saying, for me, the way I look at things fundamentally, it's just not aligned with my strategy, and everyone is open and entitled to their own strategy. So anyways, Fun video today, real-time response to one of the just great questions that I receive here on PPC and so thank you for the question. This is all my personal opinion, all my personal journey, and so but personally I love these kind of opportunities. I don't think the sky is falling, and I think the analysts are flat out incorrect, but I think there's some truth to it. There's going to be some challenge, and there already is, and I think these companies will power through it over time. Thank you for watching. In terms of full disclosure before we go today, I own stock in the companies mentioned today, which are Clorox, ticker CLX, Procter & Gamble, ticker PG, and General Mills, ticker GIS. Also, in terms of a disclaimer, I'm not a licensed financial advisor. Today's video is not investment or financial advice. This video, it's just for fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult a licensed financial advisor first. If you enjoyed the video, I invite you to subscribe, to like, to comment. All of that means the world to me. Thank you so much for being here. I will see you in the next dividend investing video. And before I go, chime in below in the questions. What do you think? Do you think these analysts are right? They're wrong? Do you think the sky is falling? Do you like consumer non-cyclical stocks right now? Or do you dislike them? I would love to hear in the comments below. I'll see you next time.